If you're here today, you are trying to understand pips and don't understand how to calculate it and what they are. My name is Diana. I'm the founder and CEO of Gilda Insights, and we're going to dive right in. So, what is a pip? A pip stands for percentage in point, and it is the smallest price movement in Forex trading. So, for most currency pairs, one pip is equal to the fourth number to the right of the decimal. Don't know if you can see my mouse here, but we have, if you shift your eyes to this number 0.001, the fourth number right of the decimal is where your pip is going to be. Now, for JPY pairs, one pip is equal to the second decimal to the right, or the second number to the right of the decimal. So here I have 0.01. That's where we're going to be calculating pips. So, for example, if you have Euro USD and it goes from 1.1 thousand to 1.1001, that's one pip. And what changed was the fourth number right of to the decimal. And there will be more examples throughout this video for you to grasp a full understanding of that. Why are pips so important when it comes to trading? It's what moves the currency pairs. In order for you to understand Forex, you need to understand pips. That's what moves the market. And it helps you to calculate your gains and losses. And it also allows you to set the proper stop losses and take profit levels effectively. So, for example, if you buy EU at 1.1 thousand and set your take profit to 1,050, that's a 50 pip gain. So, how lot sizes affect the pip value? This is where the calculations come in when you are making your trading plan. So, the lot size determines how much each pip is worth in your trade. So, here we have the lot sizes. There's standard, mini, and micro. Starting with the standard lot. The standard lot is $10 per pip. A mini lot is $1 per pip. And the micro lot is 10 cents per pip. I should have put asterisks around this for begin. Well, either way, I have it on the bottom, but the micro lot is the best option for beginners to protect your capital. If you have a small account, if you have between $100 and I would say 500, between 1 to 500, micro lot is your best friend, especially if you are a beginner trader. 10 cents a day. You may see all on social media how people are flipping and turning $1 into 4,000 and all this stuff. Start with your micro lot. Okay. You don't know what happened in between when those people place trades. Manage your risk. Okay. Protect your capital. It may seem small, but it will grow over time because in due time, if you grow that small account, you'll be able to then move up to a mini lot in no time. Trust me. So the example here is, let's say you want Euro USD to move in your favor 10 pips. So with a standard lot, you have $10 times 10 pips. That equals $100 in profit. Why? Because the standard lot is $10 per pip, and your goal is to get 10 pips. So your profit will be $100. With a mini lot, same thing. A mini lot is $1 per pip, and I'm going to multiply that by 10 pips because that's my gain. And you'll get $10 in profit. With a micro lot, 10 cents per pip times 10 is $1. Okay, so the bigger the lot size, the more money you make per pip, and you have a higher risk to reward ratio. So again, the bigger the lot, the more money you make, but can also be the more money you lose per pip movement. And again, emphasis on the smaller lot sizes is best for beginners because it's less money per pip. Protect your capital, protect your capital, protect your capital. Now, how to calculate your profit and losses in pips. So your profit and loss, also known as P&L, depends on how many pips you're gaining or losing and how much that pip is worth. So for example, let's say we have a winning trade with EU and I decided to go in for a buy at 1.1 thousand. That's my entry. And I set my take profit to 1,000, or excuse me, 1.1050. price moved up 50 pips. Now, if you traded that with a standard lot, then each pip will be worth $10. So I would do 50 pips times $10 because 50 pips is my goal. And I'm using a standard lot, which is worth $10 per pip. And that will profit me $500. Here's another example. Let's say we were going in for a a bearish position, a sell position. I wanted to sell at 1.1050 and I wanted to set my take profit to 1.1000. Price moves down 50 points. Okay, so if I traded that with a standard lot, remember the standard lot is $10 per pip. So I'm doing 50 pips times $10, 5 equals $500 in profit if that goes in my favor. Another example, another winning trade, but this is with a JPY pair. Remember, JPY moves, the second decimal to the right is what moves. So let's say we go in for a buy position with UJ. My entrance to the trade is going to be 145. Sorry, I'm so used to saying the four digits. I'm going to go long at 145. I'm going to set my take profit for 145.50. So price moved up 50 pips and my profit will be $500. If I traded that with a standard lot, again, each pip is worth $10. So I'm doing 50 pips times 10 is $500. I hope this is making sense. So now I want to go on to losing trades because it happens in the market. You're going to pay that market tuition. So let's say if I wanted to go in for a long position with EU. I set my entrance is set for 1.800. I set my stop loss below my entrance at 1.750. So if price moves down 50 points, because that's my goal, I want to gain 50 points. So I'm setting this up to gain 50 points. So if price moves down 50 points and I'm entering a buy position, let's say I traded one mini lot, which is only worth $1. 50 pips was my goal, times that $1, because that's how much is moving per pip, means I just lost $50. So my goal was to get the 50, but instead I lost it. So here we're going to use another example with UJ. Again, UJ goes by, or excuse me, JPY goes by the number. I'm always getting this mixed up. So crazy. JPY pairs go to the second number to the right of the decimal. So I decided I see the market being bullish. So I'm going to get in at 143.25 and I'm going to set my stop loss a little bit below my entrance at 142.75. My goal is to get 50 pips up, but it ends up dropping 50 pips down against my position. Let's say I wanted to trade this with a micro lot. With a micro lot is worth 10 cents per pip movement. So my goal was 50 pips. I'm going to multiply that by 10 cents, and that's equal to me losing $1. Okay, so some key takeaways here. If you are taking notes, please put asterisk by these key takeaways. If your buy trades will lose when price goes up past your stop loss. Your sell trades lose when price goes down past your stop loss. So how do we lose a trade? When it goes up or down past our stop loss, depending on if you're going in for a buy or a sell position. Your buy trades profit when price goes up. So you always set a take profit higher than your entry. Your sell trades profit when your price is going down. You set a take profit lower than your entry. So you're selling high, buying low. You're buying low, selling high. So there is a huge difference between trading regular forex currency pairs versus indices. Indices are your I don't even want to say pairs, but indices are what you see like the US 30, NAS 100, S&P 500, and they're just traded differently. So instead of going by pips, these indices move by points. So again, instead of pips, it moves by points. So 1 pip is equal to 1 point in price. Kind of the same, but different. And as you see here, the pip value does depend on your lot size and index type, and it also depends on your broker. So it is very important to research that. So if you're taking a look here at the chart, for example, with US 30, the standard lot is $1 per pip, mini lot is 10 cents per pip, and the micro lot um, is 1 cent per pip. Okay, that's pretty straightforward or forward. My God, I can't talk. All right, so we're just gonna get into examples of how to calculate these things. I hope you have written or screenshot this chart down just so you can come back to reference. So we're gonna do an example of a winning trade and losing trade with an indice. So let's say I want to go in for a buy position with US 30. So I've already written my plan. I'm entering at 35,000, and I'm gonna set my take profit to 35,050 because I want a 50 point gain. If I have a standard lot, standard moves $1 per pip. I'm gonna take 50 points because that's my goal. Times it by $1, that equals a $50 gain. Here's a losing trade example with NAS 100. So let's say I'm wanting to get in for a sell position. I told myself, okay, once it taps 14,500, I'm selling. I'm setting my stop loss slightly below my entry at 14,550. Price moves up 50 points against me because I'm in for a sell position. So it bounced off and rejected instead. And I calculated it with a mini lot. I'm using a standard, or excuse me, I'm using a mini lot, which is going to move 10 cents per pip. So with that, I have 50 points times 10 cents, which equals negative $5. So I lost $5 in this trade because it moved against me. Now, your key takeaways here when you're trading indices, remember that indices moves in points, and each point is usually worth 1 pip. Again, check your broker's contract size to confirm the pip value because it varies depending on the broker that you're using. And also the lot size does affect your risk. Larger lots mean bigger profit and losses per pip. Okay? How to use pips like a pro. The first thing, set goals. Plan how many pips you're wanting to aim to gain per trade. Also, number 2, you're managing your risk. Use those stop losses and measure it in pips to protect your capital, protect your account. So set those goals before going into a trade of how many pips you're looking to gain, but how many are you also looking to risk? How much are you willing to lose in your account that day per trade? Also, the third thing, tracking your performance. Review your trades by how many pips you did gain or lose, not just in dollars. And what I mean by that is for a long time, I was very focused on just being dollar oriented because that's the way my mind process. But it is so important to include how many pips. It is really a game changer. Learn not just by dollars, but by pips as well. Just another key tip here, always consider the pip value of your trade. It depends on your lot size and currency pair. So just to tie back into what I said, count those pips, okay? Calculate those pips. Listen to me, calculate those pips. I did a video on managing risk and how I explained no one really fully grasped the understanding, or excuse me, explaining what it was. But here I am today telling you not only focus on the dollars because that's what matters most, but focus on the pips because that's what moves the market as well. It's how the chart moves or price action moves. Now, here's just a recap of some key points if you made it to the end of this video. So, right. So, key points as they're listed here. If you are, I would highly advise you writing this stuff down. But pips, just to briefly go over, pips measure price movements in Forex, while points are used for indices. The value of a pip or a point depends on your lot size. Trading indices involves calculating points, which simplifies the process that each points represent a full price movement instead of decimals and pips. Understanding how many pips and points affect your prop P&L, I'm just going to say P&L, and it helps you to manage your risk and set realistic expectations as a trader for your trades. Now, why understanding pips is essential for trading. Understanding pips ensures, again, emphasis that you can calculate your profits and losses accurately. It helps you make more informed decisions on how much to risk per trade and to protect your capital. And mastering PIP calculations does lead to better trading management and strategy implementation. Okay. And lastly, in this video, I've also emphasized just encouraging you to practice PIP calculations for better trade management. Practice calculating pips and points with different lot sizes to get more comfortable with the process. What does that mean? Go to TradingView, find you a regular currency pair, Euro USD or GBP USD, and find you a JPY pair. You have, let's say, odd JPY or USD JPY. Just spend time just calculating the numbers. Tell yourself if you want to go in for a mini lot and you want a 50-point gain, just like the examples used with different numbers, more, I won't say complex, but just different numbers. Practice it so you can get in the flow of doing it and making sure that you do that before getting into a trade. The more you practice, the easier it does become to anticipate your P&L. So you're setting the appropriate stop losses and take profits, and you're managing your risk. When you know you're doing good and you're protecting your risk before getting into a trade, your emotions and your psychology of it is just completely different because you already know what's at stake and you know it's not hurting your account because you set that proper number and you've already accepted that is a possible loss. By mastering your PIP calculations, you do gain more confidence. Again, tying into what I just said, you let it play out. Okay. You get in the trade and you let it play out. Your emotions won't 100% take over. But for the most part, you're not sitting here biting your nails at the computer because you already know, well, I manage my risk and I know what I'm at stake to lose, and I'm okay with that number. Let's see how it plays out. If you've made it to the end of this video, I truly hope you have a better understanding on what pips are and how to calculate. Please, I encourage you, go back, keep rewatching this if you need to. Take screenshots of it. Do what you have to do in order to understand this. Please be sure to like and subscribe to this channel and stay tuned for more Forex education. Let's transform wealth through knowledge.